Oil has breached $100. The global economy is holding its breath as a new proposal drops from Tehran. Welcome back to Yearn to Grow. This channel is about understanding finance and insurance clearly and calmly. No pressure, no shortcuts, just clarity. To understand the gravity of the current situation, we must go back to February 28, 2026. This was the spark. A series of joint US and Israeli strikes targeted Iranian military infrastructure. The goal was to dismantle their industrial capabilities. The escalation was swift. It moved from proxy confrontation into direct military conflict within 72 hours. In retaliation, Tehran enforced a full closure of the Strait of Hormuz. This is the world's most critical energy choke point. 1/5 of the world's petroleum and nearly 20% of global liquefied natural gas passes through this narrow waterway every day. This choke point is the jugular vein of the global energy market. Any obstruction here sends shockwaves across every continent. For countries like Japan, the strait is even more critical, facilitating nearly 90% of their total oil imports. For countries like Japan, the strait is even more critical, facilitating nearly 90% of their total oil imports. Global energy markets reacted instantly. Brent crude futures surged, peaking near $120 per barrel. This isn't just a number on a screen. It's a massive inflationary tax on every household and business in the world. Energy-led price shocks are forcing central banks to rethink their entire strategy for 2026 and beyond. To understand why this is different, we have to look back at the 1980s tanker war between Iran and Iraq. Over 500 neutral vessels were attacked. The strait was nicknamed the Death Corridor. Shipping dropped by 25%. But back then, the world had massive spare oil capacity. Today, that buffer is gone. The stakes are much higher. In the 80s, the market could absorb the shock. Today, a 1% supply disruption can cause prices to jump $4 instantly. The tanker war taught us that physical closure isn't the only risk. The increase in insurance and security costs is just as damaging. Washington's response was Operation Epic Fury. They launched a comprehensive naval blockade of Iranian commercial ports. The blockade aimed to cut off Tehran's primary source of revenue, their oil exports, to apply maximum internal pressure. This naval containment strategy turned the entire region into a high-stakes standoff with no clear exit strategy. The goal is simple: total economic isolation. But in a globalized world, isolation is easier said than done. The US Navy is enforcing a strict no-go zone for any vessel carrying Iranian petroleum products. Here is the key insight. Why is Iran offering a proposal now? Because the US naval blockade is actually working. Tehran is feeling the internal pressure from a collapsing economy. The Iranian rial has plummeted to historic lows. Food inflation is exceeding 100%. The population is facing severe shortages of basic goods. The leadership is deeply divided. There is no consensus between the civilian government and the Revolutionary Guard. The death of Supreme Leader Khamenei has created a power vacuum, making any coordinated response nearly impossible. The civilian government is desperate for economic relief to prevent widespread social unrest and potential collapse. The blockade has stripped them of their primary leverage, forcing them to look for a diplomatic exit. This leads us to the Islamabad Accord, a major proposal sent from Iran to the US via Pakistan. Pakistan has emerged as the primary communication channel. They are the bridge between two adversaries in a direct conflict. Islamabad is brokering this framework with support from regional powers like Egypt, Turkey, and Saudi Arabia. The proposal centers on a two-phase approach to ending hostilities and reopening the Strait of Hormuz. Phase 1 is an immediate ceasefire. Phase 2 is a 20-day window to finalize a broader settlement. The immediate priority is the reopening of the strait to all international shipping. This would ease the global energy crisis. Restoring maritime traffic would bring Brent crude back toward the $90 range, providing much-needed stability. The goal is to turn the strait into something like the Suez Canal, a regulated fee-based passage for global energy security. This would turn the waterway into a regulated fee-based passage, similar to the Suez Canal's fee structure. But there is another layer to this story. The massive sanctions hit on China-linked oil. This is the economic fury campaign. Hengli is a cornerstone of China's private petrochemical sector. The US Treasury recently targeted their Dalian facility. Beijing sees these sanctions as an attempt to undermine their energy security and long-term economic growth. This facility is one of the largest in the world, with a refining capacity of 400,000 barrels per day. Mining the waterway effectively paralyzed the flow of crude from the Persian Gulf to the rest of the world. The Treasury designated approximately 40 shipping entities. These ships use deceptive tactics to bypass global sanctions. These vessels often turn off their tracking transponders and conduct ship-to-ship transfers in the middle of the ocean. It's a clandestine operation that moves millions of barrels of crude every month to avoid detection by international authorities. These ghost ships are the lifeblood of Iran's sanctioned oil trade, and Washington is finally cracking down on their networks. China's response was sharp. Spokesperson Lin Jian called the sanctions illicit and a violation of international norms. Beijing vows to protect the lawful rights and interests of its companies. They refuse to recognize unilateral U.S. measures. This keeps the geopolitical tension high as China continues to be the largest buyer of Iranian crude despite the risks. Beijing sees these sanctions as an attempt to undermine their energy security and long-term economic growth. Hengli Petrochemical issued a formal denial, stating they have never engaged in trade with Iran. They claim their suppliers are vetted. But interestingly, they also indicated a shift toward yuan-settled channels to bypass the U.S. financial system entirely. This is part of a broader trend of de-dollarization in the energy trade, which has long-term implications for the U.S. dollar. The creation of alternative payment systems like CIPS is a direct challenge to the dominance of the SWIFT network. Let's dive into the market dynamics. Energy markets have become the primary epicenter of this global conflict. We've seen flash crashes followed by sharp rebounds. Brent crude dropped 13% in a single day on ceasefire rumors. That's a lot of oil, but it's nowhere near the 21 million barrels that usually flow through the Strait of Hormuz. The uncertainty is a gift for speculators, but a nightmare for physical buyers and long-term corporate planners. Markets hate uncertainty, and the current situation in the Persian Gulf is as uncertain as it gets. Expect continued swings. Gold's performance has been fascinating. It hit a record high of $5,600 in early 2026. But then, it started to decline. Why? Because the energy shock triggered massive demand for the US dollar. Since oil is priced in dollars, the global scramble for liquidity pushed the dollar higher, creating a headwind for the yellow metal. Gold is balancing its role as a crisis hedge against the crushing weight of a strengthening US currency and higher rates. Investors are looking for safety, but in a world of rising interest rates, the opportunity cost of holding gold is increasing. Then there is the Japanese yen. USDJPY is approaching the psychologically critical 160 level. This is a danger zone. Then there is the Japanese yen. USDJPY is approaching the psychologically critical 160 level. This is a danger zone. The Bank of Japan is in a corner. They are reluctant to hike rates while the economy is facing a negative supply shock from the war. A weak yen combined with high energy costs is a toxic mix for Japanese consumers and manufacturers alike. Export gains are being wiped out. The BOJ is expected to hold rates until at least June, prioritizing economic stability over currency strength for now. Surprisingly, US equity markets have shown remarkable resilience. The Nasdaq staged a massive V-shaped recovery. Investors are prioritizing the AI boom over geopolitical risk. They are seeing tech as a safe haven from traditional macro shocks. But valuations have cooled. The forward PE ratio is down, reflecting a more cautious assessment of future corporate earnings. The market is betting that technology will continue to drive growth regardless of the price of oil. For now, they are right. But if energy costs remain elevated, consumer spending will eventually take a hit, which could end the tech rally prematurely. Now we come to the realization moment. Resolving the shipping crisis without a nuclear deal strips Washington of its primary leverage. If the blockade is lifted before a nuclear agreement, Iran could continue its enrichment with less fear of immediate retaliation. This is the ultimate gamble. Is the world willing to trade long-term nuclear security for short-term energy stability? That is the big question. Once the economic pressure is off, the window for a permanent nuclear settlement might close forever. The stakes couldn't be higher. The world is balancing on a knife's edge between immediate relief and long-term nuclear proliferation risks. There are no easy choices. President Trump is maintaining a maximum leverage approach. He's alternating between threats and sudden diplomatic openings. He recently cancelled a high-level envoy trip to Islamabad, stating that the US has all the cards. He's playing for a total win. Washington wants a 10-year suspension of uranium enrichment. This is the ultimate sticking point in the Islamabad Accord negotiations. Trump is betting that Tehran will buckle under the weight of the blockade before they can find an alternative. It's a game of chicken. The takeaway for you is clear. Monitor the headlines, but watch the volumes in oil and gold for confirmation of any move. In a world of information overload, clarity on the primary market triggers is your most valuable asset. Stay focused on the key levels. In a world of information overload, clarity on the primary market triggers is your most valuable asset. Stay focused on the key levels. Whether it's a breakthrough or a breakdown, being prepared is the only way to navigate this volatility. Keep your eyes on the data. Real growth comes from understanding the underlying forces at play, not just reacting to the noise of the day. Stay disciplined. Some say we can just bypass the strait. There are pipelines in Saudi Arabia and the UAE designed for exactly this. Let's look at the capacity. The Saudi East-West pipeline and the Habshan-Fujairah pipeline have a combined capacity of 6.8 million barrels a day. In moments of global uncertainty, clarity is the most valuable asset you can own. The math doesn't add up. Bypassing the strait is a partial solution at best and a total failure at worst. The world needs that water. So, what are the 3 real triggers that could drop at any moment? These will define the market direction tonight and for the rest of the week. Trigger 1, the official US response to the Iran proposal. If they accept terms, oil cools and markets go risk-on instantly. Watch for the official statement from the Oval Office. If they reject it, expect oil to spike and gold to rally as a flight to safety. The markets are watching every word for clues. Trigger 2, any headline regarding Hormuz shipping or security. Mines, seizures, or naval incidents move markets in seconds. A single security headline can move US oil, gold, and the Japanese yen within seconds of the news breaking on terminal screens. A bad headline or a shipping incident, oil up, gold up, safe havens will be in high demand. Trigger 3, sanctions escalation and China's retaliation. Beijing's response to the Hengli sanctions could spark a wider trade war. Trigger 2, any headline regarding Hormuz shipping or security. Mines, seizures, or naval incidents move markets in seconds. The yen will spike, and stocks will see a sharp sell-off as investors flee to liquidity. Stay alert. In this environment, even without major economic data, geopolitical headlines are the primary driver of all price action. Let's review our super simple what to expect map. Save this or write it down. This is your trading guide for the current crisis. A good piece headline, oil down, gold down, stocks up. Conversely, a clear signal that the strait is safely reopening would be the biggest risk-on trigger for global equities this quarter. In moments of global uncertainty, clarity is the most valuable asset you can own. Whether in oil, finance, or life, those who understand the game and stay the course are the ones who ultimately prevail. Trust your research. If this explanation helped you see things a little more clearly, that is exactly what this channel is meant for. We will continue breaking down finance and insurance concepts step by step in a way that feels practical and manageable. If you find this helpful, please like the video, subscribe to the channel, turn on notifications so you do not miss future videos. Trust your research, and as always, keep yearning to grow.